Ladies and gentlemen, good day, and welcome to Kelkar and Company Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and thank you for joining us on Kelkar and Company Limited's Q2 and H1 FY 2026 earnings conference call. We have with us Mr. Kelkar, Full-Time Director and Group CEO, and Mr. B. Ramakrishnan, CEO, Fragrances Asia and USA of the company. We'll begin the call with opening remarks from the management, following which we'll have the forum open for a question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Kedar to make his opening remarks.
Hi, good evening, everyone, and thank you for joining us today at our Q2 and H1 FY 2026 earnings call. I trust that you have a chance to review the results document. During the first half of FY 2026, we reported consolidated revenue growth of 12% year-on-year, driven by steady demand across all our core categories, continued traction with both existing and new customers. The fragrance business sustained its growth momentum, supported by stronger relationships, particularly with small and mid-sized clients, and the flavor division delivered healthy performance across the board, both in domestic as well as export markets. In the European fragrance business, the business environment remained soft, and therefore sales were muted in the first half. The brownfield expansion in the Netherlands is progressing as scheduled and is expected to be commissioned by end of the fiscal year. Once operational, it will help address capacity bottlenecks and improve cost efficiency. With market sentiment gradually improving and new capacity additions nearing completion, performance in this region is again expected to strengthen in the next year. The ingredient segment had a muted quarter, impacted by demand softness and uncertainty arising out of tariffs. The continued trade uncertainties are getting resolved, and the medium and long-term outlook remains encouraging, supported by supply chain diversification, new product additions, and increasing demand from European customers. On the profitability front, I would like to point out that H2 FY 2025 serves as a more appropriate base for comparison, as profitability in the second half had dramatically dipped due to sudden spikes in raw materials and on account of new initiative investments coming to fruit. So comparing to H2 FY 2025, the margins during first half remained broadly steady, while we see and recognize gross margin improvements in the underlying raw material situation. Due to the inventories, these are the full effect of the decreases are not yet factored in our results. In total, we recognize that the reported margins were lower during the quarter, reflected also ongoing investments made to strengthen our growth ambitions in new geographies. In total, rupees 32 crores was invested in new initiatives during the first half. Further, rupees 7 crore were incurred additional insurance costs during this period. Adjusted for this, our EBITDA margin stood at 14.5%, broadly comparable to the 14.4% in the H2 FY 2025. We believe these investments in expanding our creative centers and capacity enhancement projects across India, Europe, and the US are essential building blocks for sustained growth and profitability over the next decade. As these initiatives contribute to our performance over the next 15 to 18 months, we expect margins and profitability to substantially improve. To conclude, we remain focused towards our long-term vision of emerging as a globally recognized leader in fragrances and flavor solutions. Our sustained focus on R&D and innovation will continue to enable us to create differentiated products and technologies, many of which are being developed for the first time in the world. We are confident that this commitment to innovation will be central for our next phase of growth. With that, I would now request the moderator to open the floor for questions. Thank you.
Thank you very much. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask the question. The first question is from Jatin Chalu from RTL Investments. Please go ahead.
Yeah, hi. Good evening, and thanks for the opportunity. I have a few questions. So the first one is this 32 crore amount that you quantified for investment in new initiatives. That is for the first half, right? What's the amount for the second quarter? Just to get a sense on the margins. Because second quarter we have seen a much bigger impact on margins.
About 17 odd crores.
Okay. Got it. And this additional insurance cost, 7 crore, was largely again in 2Q only?
No, this is again for the half. Quarter 1 and quarter 2.
Got it. And in terms of development center...
Full year.
Okay. So there will be a 7 crore cost in the second half also?
That's correct.
Got it. And on the development centers, you mentioned India, US and Europe. So earlier, I think you were talking only about India and Europe. So US is a new initiative?
So yes, US is a new initiative. Europe we have already done. US it has been sort of operationalized. That's why I mentioned it specifically this time now.
And this is this investment in US, is it again to kind of further penetrate deeper into our global MNC account, or is this for some new client that you're targeting in the US market?
A global MNC account, and also we anticipate good domestic business momentum in the US due to the tariffs. So we are focused on US market and manufacturing within US as a quick turnaround.
So this is not only a development center. Will this center do some manufacturing also then in that case?
No, we will align with the manufacturer locally.
Okay. So you will do domestic sourcing.
Leased out tolling or leased model.
Got it. Got it. Is there a my sense was that this is for a client in their product, this will be a very small value. So, the fragrances that you supply. So do they really care so much about 15-20% tariff on that kind of a product?
No, so it's not only about tariff. It is also the fact that we have ability to produce locally and we can give good products at a competitive rate. So it's not only about cost, it's also making the right products, which is why our development center has been started first. We are making, development on kind of consumer-like products. And the 15% tariff additionally helps us if we manufacture within the US.
Got it. Got it. And one last question. What's the traction with the global MNC client? Have we seen any further traction this financial year? Because looking at the numbers, it seems, and your commentary, it seems the growth is largely driven by the domestic small and medium clients. So you haven't really seen much traction with the global MNC clients.
Yes, so it is in line with the growth. There is no big jump so far. We expect second half we will see some more traction. It is typical how things have been evolving with the larger accounts. Whereas first half we have no substantial new win, or new adoption. They are a bit slow on that, as I mentioned last time. But business is, there are projects in the pipeline. Their adoptions are a bit slow.
Got it. So then in the second half and...
Some project, yeah.
No, sorry, go ahead.
No, we have won some projects. They are just not adopting and starting that immediately. So we expect that ramp up will happen.
Okay, so projects have already been won with them. Got it. My commentary was, what I was saying was, so from what you are saying, it seems second half and as we head into FY27, should we expect that this 11-12% growth rate will further improve on the back of some traction with the global MNC account and the development centers that you have created in India, US and Europe?
Yes, I think there is growth momentum. So if you look at the first half, April, May was very soft, particularly in Europe. Subsequent momentum is much stronger than the first couple of months. So we expect second half to be better than the first half. In most years, the second half is much higher growth than the first half of the year.
Got it. Sorry, one last question. On raw material, you said the RM prices have already improved, but you have not seen the benefit yet. So when the benefit does come in, what sort of gross margin improvement do you expect?
So we went from 45 to 39. We are somewhere around 42%, 42.5% for this half. Things will improve from here further percent. I think percent and half, something like this, going forward.
Got it. Thanks a lot.
Thank you. Next question is from the line of Abhijit Akella from Kotak Institutional Equities. Please go ahead.
Yeah, good evening. Thank you so much. So couple of questions from my side. One is on the expenses. So this quarter there's been, some further sequential increase in the expenses. Of the 38 crore incremental cost that we called out, in 1H, how much would the amount be for 2Q overall?
Q2 is about 17 crores. I already mentioned it.
Yeah, that's 17 out of 32.
Peak level of new initiatives. Everything that we were planning to put in has been put in, and this is now the run rate, and it will start to generate revenues against these investments.
Okay, so 17 out of the 32 is in 2Q, plus maybe 3.5 crores out of the insurance, 6-7 crores is also in 2Q. So total.
That's
okay,
correct.
got it. So about 20 crores overall in 2Q, and yeah. Okay. And this is the new run rate. On the revenue side, on a sequential basis, 2Q versus 1Q, we've seen some softness in the India side of things. Fragrance revenues are a little bit lower. Flavors also down sharply, I think, from 43 crores to 26. So anything to read into that, or is it just a phasing issue? And should we expect a pickup as the GST benefits come through?
Yes, just seasonality. I don't see anything big. I mean, quarter two is slightly below quarter one. That's nothing to be called out. I think there is an effect of Diwali being a bit earlier in this calendar, so some of the sales are a bit earlier quarter. But nothing specific in terms of it's business as usual. And we expect, yes, as you mentioned, with the GST and the second half sales, definitely will see a bigger momentum. There has been some categories, particularly things like ice creams and beverages, where extended rains have meant that demand has been lower than normal in the flavor side. But nothing which is, substantial or kind of a strategic difference. Things will catch up in the second half.
Okay, so just on the outlook front, we are still guided to 12% plus revenue growth for this year, right? So on a full year basis. And on the margin front, the annual report had previously mentioned a figure of 18 to 20% EBITDA by FY27. So, I mean, I know the investments we are making are fairly heavy, but, any number we would like to hold out there, that we could sort of take expectations with?
I see that about a percentage will come straight away from the gross margin as the raw material situation improves. Additional percentage will come in from the operations getting into consolidated factory. These are the two expenses which are currently much higher. On the new initiatives, we have good traction. We have already seen roughly annualized basis 3 to 4 million of business approved. So it's a matter of time before that starts to be supplied. So these are all very positive signs, and I mean the business momentum is there. I am not. I think the growth will compensate for all the investments we are doing.
Okay. Right. Okay, fine. Yeah. Thank you so much. I'll come back in the queue for more.
Yeah.
Thank you.
I mean, if you see one of the indicators is one of the indicators of the rest of the world growth. It's been strong and it's continuing. These are all the new areas.
Thank you. Next question is from the line of Prakash Toshniwal from LIC Mutual Fund. Please go ahead.
Hi, good evening, sir. Thank you for this. So just trying to understand, you're saying gross margin improvement of 100 basis points from in the H2 FY26. Is that correct, which I understood?
That's correct.
Okay. And in past, we have mentioned that raw material cycle is almost getting shorter. So 6 months, 7 month visibility we used to have. Now you're saying that that visibility is there at least for the 1 year. Is that what I understood when you say that 18 to 20% margin is possible in FY27? So just can you just elaborate more on the raw material?
I think the raw material situation, we know where we are in the coming 12 months, plus the factory cost and the additional transport, additional logistic, all of the additional cost we are incurring in the current manufacturing. We are operating smaller plants in multiple locations. So those things will all be reduced.
Okay. And the growth side, is it a 15-16% is a reasonable number to expect for once your everything materializes for this year, FY27, can we expect a 15-16% kind of growth number?
Yes, I have always sort of said about 15% kind of growth year on year, with a occasional year or half a year where there is some macro event or something which disturbs the growth. But underlying business momentum is strong. We see continued traction. I don't have any concern with 15% growth year on year basis.
Okay. And just on this one-off expenses which you have made investment 32 crore in first half and 17 crore in Q2, what is this number possibly if you can guide for Q3 and Q4 going to be?
So the number is going to remain around the 17 crores per quarter. So 32 crores for the second half or 33 crores. Bit depending on the currency exchange rate. In rupees it will change a bit, but the dollar euro basis it's now fully costed in. There will be it will be kind of, this is the new cost structure, and the growth for this is now started to come in. So we have been at it for last 12 months. The teams are in place. Sales teams have started visiting. Some initial trial orders or initial feedback has started coming in. So we are looking at maybe another 6 months, but thereafter it will start to generate strong revenues.
Okay. So just last requestly point out, it would be great if you can schedule a call post-result as early as possible. This 2-day gap is really making us anxious as an investor.
Right. I will keep that feedback in mind.
Okay, sir. Thank you.
Thank you. Next question is from Bharat Gupta from Fair Value Capital. Please go ahead.
Hi, Kedar. I hope I'm audible. Couple of questions.
Yes.
So first, with respect to the profitability for the second half, I think somewhere in the last con call you mentioned that you will be maintaining a EBITDA margin of somewhere close to 15%. Going by the first half, I think with order to achieve on this particular front, we need to have a run rate of 220 odd crores going forward. So how, are you going to revise this guidance or you are currently sticking with it? Because like you mentioned that the cost will continue to incur in the second half as well.
Yeah. No, I will come back with the exact number drilling down with latest estimates, but the growth momentum is very strong. It's not different than what we expect. The exact cost vis-a-vis the new initiative and the currency we can factor with the hedging, and we will put out a revised estimate. But it's I think 14-15% we should be able to achieve.
Right.
Once the factory.
Right, go ahead.
So once the factory is operationalized in this quarter, early next quarter, we'll see a sharp drop in the operating expenses.
Right. So secondly, with respect to the post the GST reforms, have we seen any particular momentum with respect to our tier 1 clients or the MNCs? Were they holding on the inventory and that is why the domestic demand was muted from their end?
No, we have not seen any decline in revenues. We have not seen any uptick either. It has been business as usual. Although the reported numbers for some of them are on a lower growth trajectory than previously, we have not seen substantial change in our sales.
Right. And sir,
again, I believe second half growth will be better.
Right. Right, sir. And so the run rate you mentioned, close to 97 odd crores with respect to the other expenses, that will be the run rate going ahead for the subsequent quarters as well, right?
90?
For this quarter, it was somewhere close to 98 odd crores. That will remain for the subsequent quarters.
So the operating expenses are now at the level which is the maximum. We also have our annual increment cycles, all of that happening in the second quarter across the world. So all of that is factored in. The quarter 2 numbers are more or less I would say steady state, barring whatever currency exchange rate difference may be there.
Right. So this run rate is likely to be there for the second half. Right.
That's correct.
Right. And just a question on the debt numbers. So we have seen an increase from the March quarter. How do you see whether the debt number will remain on this particular level or there will be a reduction by the second half?
So we are following up with the insurance on substantial payments which are expected any moment. Keeping that in mind, the debt numbers would start to come down. And our last investments in the factory are happening as we speak. So it's kind of difficult to know exactly end of March, but I expect it will be at this level or slightly lower than these levels. Some of the debt in European terms or US dollar or euro term has been now restated. That itself adds to roughly 30 crores of additional debt, which is in a way notional because the sales and revenue and profitability is also in euros. So that should offset the additional debt in terms of cash flow.
That's it from my side, sir. Thank you so much for answering all the questions.
Next question is from line of Anil Bagaria from Equicorp Partners LLC. Please go ahead.
Thank you for the opportunity, sir. So I just got some few strategic questions. Sir, with respect to the US geography, so what is the strategic roadmap? Because when we entered Europe for the first time, we had actually done two acquisitions, that is Holland first and then CFF, and it then took us a decent amount of time to turn it around, and then we got access to market as well as tech. So given our current debt size and our revenues and our cash flows, I don't think so we'll be in a position to do any acquisition in US. So what's the strategic roadmap there to grow the business? So, and the related question to that is, since you've put up a new creative fragrance center in New Jersey, so what is the standalone cost for that? And based on the current tariffs and also the supply shocks and the consumption shocks there, are we seeing any drawback in terms of OpEx right now? And probably once things start getting more clearer, we would gradually increase the number of people deployed there and then take it to the fair levels what we've forecasted.
So the US strategy basically has been development center more or less on the fact that we have the tie-up with the global accounts and we needed to be in the US market to take up some of the projects there. As we are already set up this center, we are also looking at some smaller and mid-sized companies or customers within the US. So this has been a kind of in addition strategy. We are not expecting to increase our number of people on this front. We have a sort of, I would say, satellite development center. It is fully equipped to address the needs of the US customers, but it will continue to be supported from Europe and Asian creation centers for additional resourcing as and when it's required. So it will not be a full-fledged development center in the US, but it is a kind of a satellite center which has support from the other centers for all its creation and development. Our main strategy in the US is to look at the patented products and technologies and to focus on the larger accounts where we are proposing some of these new disruptive technologies.
Okay. So the large FNF players are actually focusing more on the natural extraction side, on more using more on of the biotech technology side, and they've been actually also tying up with a lot of players. So 2022, 23, 24, we actually saw a lot of them actually do major acquisitions, large acquisitions, and now they are talking to smaller players, niche players on strategic ties where they don't need to invest money. One provides tech, another provides manufacturing. So are we seeing some kind of development there, given we've got a large manufacturing facility in India, as well as we've got an expanded one in Europe and probably a tolling one in the US also?
Yeah, so we have our manufacturing footprint. We do our own manufacturing for products that we develop. So we are sort of doing the full service. I believe there are some business models which are taking only development and getting it produced from a kind of a third party. All of these are models which are sort of, I would say, more short term. Unless you put your own manufacturing capacity, you can't really scale up the business.
So actually, to be specific here, so Givaudan had actually done a strategic tie with one player which had got very good tech on the biotech side. So probably we have some tech and probably some large FNF player where Givaudan actually did the exclusive marketing and the player will do the exclusive manufacturing like that.
Yeah. So they have acquired technology from Amiris in part of the bankruptcy proceedings, and they have done that. But it's very, very small part of the overall business. So it's a one, or let's say, one or two ingredients in the whole business.
Okay. So also lastly on the global ingredient side, I think so things are fairly moving forward for us. So we actually denied investing more money into the project, and we were actually looking for any strategic tab that could probably come and we could have some joint manufacturing facility out there. So is there any progress there? Because one of our peers has actually been successful in a decent sized order win and a project win for in this particular space.
Yeah, so we have backward integrated. That project is already executed. We are seeing that benefit of that has come into the global ingredients business, which has turned around from a negative EBITDA to a positive EBITDA. This quarter or this half, there is further pressure from China in terms of the costing. But we are still profitable, and we will continue to grow that business.
So, but since all these players, large players, are shutting down facilities in U.S. or Europe and moving a lot of products to low-cost geographies, any traction, any large inquiry that we are seeing? I actually wanted to get that.
Yeah, so we do have business with the bigger companies or tolling or relocation business which comes our way. But the global ingredient is not counting this business. That's part of our normal fragrance or segment, normal segments.
Okay. And lastly, yes, sir.
No, there are opportunities definitely from what is happening in the chemical space. So we will also look at some of them, but at the moment I have nothing to announce.
Sir, lastly, just on the RFQ tender side, so we got a decent size win of about $10 million contract per annum. So are there any more such decent size RFQs in tender? And also there was one flavor tender that we had actually filed with one of the FMCG. So any updates out there?
So flavor tender, it is approved. There are some initial trial orders which have gone. We wait for that as things materialize. It's going to take long time on the flavors. It takes multi-years of sort of growing the business. On the global contract, yes, we have more than 10 million assured business for this year, and we are continuing to submit and make inroads in newer projects. But there is no specific adoption. So while we have won some things, they are not yet launched or they are in the process of being launched.
Okay. Thanks a lot, sir. I'll fall back to the queue for more follow-ups.
Thank you. Next question is from Deepanjana Chatterjee from Spark Capital Advisors. Please go ahead.
Yeah, hi. Thanks for taking my questions. So I want to just confirm on a few dots that I must have missed. So you're planning for revenue growth. What is the revenue growth figure that you are planning at on a CAGR basis between FY26 to FY28 on revenue and EBITDA lines?
So on the revenue side, about 15% growth year on year. That's our CAGR expectation over the next 3 to 4 years. On the EBITDA level, I think we are quite low at the 11-12% at the moment, and it should progressively catch up and be more close to the 18% EBITDA level, which we expect it to run.
So EBITDA is 18% is your EBITDA margins that you're talking about, and EBITDA is like 11 to 12% YOY growth that you are projecting, right?
No, the YOY growth will be higher than that because we see basically if you do 15% CAGR growth with the operating leverage and the factory reinstatement of the factory and operations, we will see faster growth on the EBITDA.
Right. So 15% will be like what? It will be the CAGR growth, right, for over 3 to 4 years, EBITDA.
Yes.
And on a YOY basis? Okay. And on a YOY basis?
YOY basis the same. We expect that EBITDA will jump up more than 15% per year on year.
Okay. There's a fundamental question. Actually, I am new to the company. So, what are these creative development centers exactly? As in, what do they really do? I mean, are they into manufacturing or what is that? How did you come out with this idea of setting up creative development centers? If you can please give us a fair explanation.
Creative Development Center is basically a business development center which includes sales, marketing, and the product development. So every new geography, every new category we enter, we develop the products for that market. So it's a basic business development work that happens in our industry.
Okay.
So we have 5 creative centers, 6 creative centers in our Europe and Asia. We have added 3 creative centers in the last year in new geographies, UK, USA, and Germany.
Okay. All right. In the call to one of the participants, you mentioned that the new 32 crores will be a new cost structure. So are you planning to report it under the other expenses column in the coming years of your annual report, or how is it? How are you going to plan it?
No, so the cost of the creation center and new development for 2 to 3 years, there is no substantial revenue behind it. So only after 3 or 4 years, the cost and revenue start to be comparable. So in that period, our EBITDA will be muted till this creation center start to deliver.
Thank you. Anjana, can I request you to come back for a follow-up question, please?
Okay, just one last question, and that would be, can you please give us about your collectibles, as in, is your working capital improving, as in, will it be below 80 days, or how would it be for the coming 1 to 2 quarters?
So again, working capital is on the higher side at the moment, largely in inventory. We are keeping inventory in multiple locations. That adds to the overall inventory to sales ratio. As the new factory facilities kind of start operating, the inventories will reduce as a percentage of sales.
So can we assume that it should be around 70-75 days on an average going forward around 27-28?
The current inventory levels are around 145 to 150 days of sales. That should come down to 130 days.
Sorry, Debanjana, I'll request you to come back for a follow-up question.
Okay.
Thank you. I request all the participants, please restrict to 2 questions per participant and rejoin the queue for a follow-up question. Next question is from Lano Bharat Seth from Quest Investment Advisors. Please go ahead.
Hi, good evening, Kedar, and thanks for the opportunity. Kedar, see what I understand that you spoke on the softness in the Europe business. So Q1 also there was a degrowth, whereas even in Eurotop, whereas I believe there is also degrowth in Q2, where the EBITDA margin is for 24-25 was reported EBITDA margin was around 22%. So how do we see that is pulling down, and when do we expect that Europe business will start again? I mean, reviving again. Other side we are doing a brownfield expansion.
Yeah, so Q2 is already better than Q1 in terms of revenue. And gross margin is the global same raw material effect, so it is Q2 is better than Q1. Although the EBITDA in Europe specifically is kind of combination of product export to the to North Africa and Middle East. That ratio is higher in this quarter. But these are all seasonalities, nothing specific. Gross margin is improving across the board as raw material prices are coming down.
Okay. And second thing, I mean, on again a gross margin, we were expecting that with price increase that we took, as well as, I mean, raw material softness that we are seeing. But I mean, still we are talking of only 1.5% kind of a improvement, whereas, I mean, vis-a-vis what we were expecting to normalize, say, around 43-44% for FY26 second half.
Yeah, so we are already at 42.4% for the first half of this year, and we will further improve by 1% in the second half.
Okay, and last question on this insurance. What is the status of the factory that we, I mean, got a fire? We were expecting also to restart these in somewhere H1, I mean, second half of the FY26. Any color on that?
So there are 2 factories which are being built. The first factory, which is the new brownfield one, which is coming up, it is on schedule. Ideally, first quarter calendar, so fourth quarter this financial, it will start operations. I don't think full-fledged operations will take another quarter for all the things to kind of be smoothly running there. So it will start in the fourth quarter of this year. The Washivili factory itself has been kind of gutted. Site has been cleaned, demolished. All the work has started there, and we expect this work to also complete in terms of the insurance before end of March. The factory will not be operational because we will then sort of use the new factory first, and this factory will become operational 6 to 9 months thereafter. The second half 27,
Yeah.
we will have the second factory, and already first half or last quarter this year we will have the first factory up and running.
Okay. Okay. All the best, and thank you.
Thank you.
Thank you very much. Next question is from Sandeep Sabharwal from sandeepsabharwal.com. Please go ahead.
Siddharji, I've been attending your conference call last 4-5 years. Now, so there have been many occasions where you talked of improved margins, and some raw material goes up or some event happens, etc., and the margins don't move up. And then there have been several times you have talked of reducing debt, but then debt has also trended up. So, and there is so much volatility on a quarterly basis, like this quarter results suddenly are down substantially over last quarter. So how does a minority investor invest in your kind of company where there is so much unpredictability? Hello?
Yeah, I am stumped by the question. I understand that there has been events which have happened. Some are macro events which have affected everyone. Some have affected specifically to our business. The only good way to look at it is on the longer term, kind of trailing 12 months or 18 months comparison, because quarter on quarter things will look very volatile.
And this 7 crore additional insurance money which is getting paid out, now this will be paid only this year or it's a regular thing now?
So they have, as a result of the incident, they have charged us an additional surcharge, which will be 14 crores for this year. We will negotiate it as the new factory comes online. So this is, I expect to be there for 1 or 2 years maximum. It depends on the final negotiation with the insurance company.
Now you have talked of improving margins when the new factory comes up. Now, when initially the new factory starts, then won't there be another phenomena where because of startup costs, etc., the margins could actually take a beating initially before improving? So when you talk of improved margins in the second half and going into 2027, are you very sure that it will correlate with your new factory starting?
Yeah, so point is well taken. We will have 1 or 2 months of startup and relocation, so there will be an overlap cost in that sense. But we have the opportunity with the 2 factories to start to reduce from 1 factory and start to move in a phased manner.
No, but with all of this also you are sure about whatever you are saying on the second half margins?
That's correct.
Okay, best of luck. Let's see.
Thank you.
Thank you. Next question is from the line of Madhav Marda from Fidelity Investments. Please go ahead.
Sorry, sir, I joined the call only 10 minutes back. I wanted to, did you sort of guide for margins, EBITDA margins for FY 26, given where we are on the first half? Did you give a sense in terms of how the full year is looking?
I will put out the latest estimate. I have not given any guidance, but it is basically improving from the 11%-12% to 14%, 15% and upwards.
No, so by when do we expect to be at 14%-15%?
The second half, effectively, second half this year, we will start to see improvement versus the first half.
So you think 2H margins will be 14%-15%, or that takes longer to achieve? That's what I was trying to understand.
It will be second half margins will be 14-15%, probably quarter 4 more than quarter 3, and then the year after we can look at even more improvements.
Okay. So the in sort of the margin pressure that we've seen in quarter 2, a lot of it is, or it seems like a lot of it is driven by build up in cost, right, at the employee and the SG&A. Could you give some sense in terms of what are these costs? I think it's probably from the creative development centers. So could you give a breakup?
So the 32 crores of additional new initiative cost vis-a-vis last year to this year.
Okay. So any reason why we had to go so aggressive at these costs, at the cost of our margins? Like, do we see like very large scale up in revenue from these initiatives? Because we pick up a lot of cost for some reason, right? So I just want to understand the
These are all new geographies. Yeah, we have decided to enter new geographies quite aggressively last year, and this was all decisions and actions which have been taken before the fire incident. So we have continued the action. We have not reduced our expansion plan on that basis. So we are seeing at the moment kind of a double whammy in the sense that the expenses for the longer term strategy we continue to go ahead. We still have some challenges in our current business on the operations and kind of factory cash flow, which should even out in this year, second half, first half next year.
And this 32 crore, how is it split across various geographies, like Europe, US, and other markets?
Substantial part of it is in Europe. I would say US is 1/3 and Europe is 2/3. Ballpark, I don't have the exact number, but I can send it out.
And this is all employee costs, is it? Like all of this expense is employee costs?
Mostly employee cost plus lease, rentals, things like this. OPEX and employee. Mostly employee. 70% should be employee cost.
Okay. And the investment that you're making in US, how much time does it take for us to generate business there?
So we have started generating business, but for it to be meaningful will take 2-3 years of time when it's kind of first 2 or 3 years, it's more or less, I would say, CWIP. It is not sensible to look at it. Second or third year, we will break even and it will start generating normal business sense.
Mm-hmm. So just one question, could this not have been phased over like 1 or 2 years and we could have done it in steps rather than front-ending all the spends right now? Like, was it very pressing to kind of front-end so much expense right away?
No, we actually did this in readiness with the global account next cycle. So we are ready with the geographies where we are not present before the next cycle comes in. So that's the main motivation of having done that. Yeah, if we had hindsight is different and without the fire incident, we wouldn't be talking about it with so much attention. I think with the fire incident, obviously our cash flow and the investment appetite or investment could be more staggered, but that is the situation we are in today. At the time when we decided it was following the global account and going into the biggest markets for our innovation pipeline. So I don't see that is it's a wrong decision. But in the current environment, we have to monitor it carefully and, look at ensuring that the deliverables are faster than over longer periods.
Okay. So just last question again on the margins only. I think we've in the past indicated, we want to get to the 18% plus EBITDA margin. How many years out do you think that is possible to get at?
I think 2 to 3 years.
Okay. All right. Thank you.
Thank you.
Thank you. Next question is from the line of Manoj Pagadia from EasyCorp Partners LLC. Please go ahead.
Hi, Kedar. Thanks for the opportunity. Can you hear me? Hello?
Yeah. Hi.
Yeah. Hi, Kedar. Kedar, I have a broader question which is somewhat related to the previous participant you asked, right? I mean, that was somewhat similar to the calibrated growth, what you could have. So if I go by the numbers, what you have, you would have about 68 crores of new initiative investments this year and next year. And if we assume it doesn't give much return for next 2 to 3 years, that means we are talking about 150 to 200 crores kind of new investment in new initiatives. And considering where we are in terms of the recent fire incident, the way we are with the margins what we have in the business, it seems the risks are very high in the business at this time. And God forbid, if some macro event happens, I think there is a significant risk. So what are we trying to do to reduce the risk exposure what we have? I mean, what's the strategy?
Yeah, so I mean, this is again the point of decision and the aftermath of the fire. So we are now very careful on, not initiating anything new from a capex or additional opex point of view. This quarter we would be at the maximum point of all the new initiatives and opex. So we will track from here on. I would say that is important for us to monitor it carefully month on month as what is happening, because the investments are the right investments. We need to ensure that we get the returns on them earlier and monitor them very carefully. That's all I can say. Is it appropriate that we do all of this at one go? As I mentioned to the earlier question, we have decided to do this in preparation and in anticipation of the global accounts engagement in various geographies, including the US and Europe. So we have taken this stance that we will be ready in the 2-3 years time. Unfortunately, we had the fire incident in midst of this 2-year or 1-year implementation. So we will be careful. We very much understand the risk and we understand the gravity of the situation. And as soon as the insurance money and the new factory comes on board, things will look much better.
In the meantime, can we do something different than what we might not have done? Like something what we have the contract manufacturing business in Europe, something similar here or something else, or maybe try and divide the risk with maybe potential investors in sharing some potential returns with somebody else. Is there some way we can de-risk? I mean, my only thing is I'm just thinking about the risk factor as of now.
Yes. So I will take that feedback. Thank you for this comment, and we can evaluate if there are some proposals on this kind.
And is there any initiatives or a possibility where you can reduce the cost? Because the new factory would start probably by end of this year, by March, right? So it will give us some savings.
I just want to put a kind of context to this. We are talking about 32 crores or 60 crores of investment, which is in a way discretionary. If we decide to exit US, exit the European market in certain way, we can, these are of nature where we have decision depending on the output and performance. So we need to give it 2-3 years of proper running. but it is not in the form of a permanent cost structure on our current business.
Yeah, because the issue was, like somebody else said, Kedar, we are almost at the IPO price, and if you see the returns since the time of IPO, unfortunately, so many events happened in between, right? And that's why we don't have control over so many outside events. And I hope something happens, then we try and reduce the risk. I'm not sure, but hopefully over the next couple of quarters, you will see some steps from us which can try and de-risk
Sure.
and maybe improve on the top line.
I think. Sure. Top line has been improving. We will continue to do it. I think the management of the cost and how many new things we can do at one go, we will need to control that, and we will definitely bring that in line with the requirements on return and return on investment.
So hopefully we'll not have any more further financial major investments or anything else for at least next 1.5 years. Right?
That's correct.
Okay. Hope financially we become much stronger over the next couple of years. Thanks a lot, Kedar. Appreciate the opportunity.
Thank you. Thank you.
Thank you very much. Ladies and gentlemen, we'll take that as the last question. I'll now hand the conference over to the management for closing comments.
Thank you. I hope we have been able to answer all your questions satisfactorily. I take some of the suggestions for the participants and look at detailing the financial performance improvements over the next 18-24 months. Apart from that, should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call.
Thank you very much. On behalf of SH Kelkar and Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.